I'm very happy to meet Varun Khanna. He is Managing Director of KKR, and we are here to talk about asset-based finance. And your presentation today is named Diversification and Inflation Protection in the Private-Debt-Welt. So please classify the asset class within the private debt universe to make it clear for everybody.
Sure. Well, thanks for having me here today. Maybe I'll start with the basics. So what is asset-based finance? It is a large and fast-growing segment within the private debt universe. The strategy is centered around investing in diversified portfolios of assets. These assets can be of three types. They can be financial assets, like loans or leases made to consumer or commercial borrowers. They can be physical assets, like a portfolio of planes leased to a group of airlines. Or they can be contractual assets, like a portfolio of IP rights or intellectual property rights. The asset types can be varied, but the common theme is these assets tend to be associated with sticky, predictable, sometimes even contractual cash flow streams. So when you invest in asset-based finance, the value of the underlying assets gives investors downside protection, principal protection, and the associated cash flow streams tend to give you an attractive current income profile. So that, in a nutshell, is what we mean when we talk about asset-based finance. So, a few points I want to make. First, it is a large marketplace. The private asset-based finance market, as we define it, is a $5 trillion market. It sits within the private debt universe, but is the largest market segment within private debt. This $5 trillion market has more than doubled since 2006 in size, and we expect it to grow to over $7 trillion in the next 5 years. That is important because it's a market, in our opinion, that's too large to ignore. The second salient feature that's worth highlighting when we talk about asset-based finance is its ability to give most investors and capital allocators a diversification tool. What I mean by that is private debt investors in particular tend to be over-allocated and overexposed to corporate credit and corporate cash flows. Asset-based finance is a good way to diversify away from typical corporate cash flow risk. Our macro team recently did a piece of work analyzing the correlation of various public and private asset classes that investors typically tend to be allocated to, spanning all the way from private equity to real estate to infrastructure and all forms of public and private credit. Interestingly, when you look at correlation of performance of each of these segments with each other, asset-based finance comes out to be the lowest. Further on, the segment as we define it is quite broad within itself. If you remember, I talked about asset-based finance making up financial assets, physical assets, and contractual assets across 4 segments of consumer credit, commercial credit, transportation, and contractual cash flows. So there's quite a lot of diversification within asset-based finance itself too. So the diversification point is at the heart of the strategy. Investors get diversification within asset-based finance, but also get very valuable diversification away from their traditional portfolios. Last point I'd make on this is it is a very interesting time to be investing in asset-based finance. In the current macro environment, all of us are worried about inflation, higher rates. Asset-based finance as a strategy involves investing in collateral-based cash flows. That in itself can be very defensive in nature. The absolute returns, on the other hand, remain quite compelling, and you have to be seen side by side with the defensive characteristics of the underlying investments. The hard asset or the real asset segment within our investment strategy gives investors a good degree of natural inflation hedging because the value of these hard assets tend to rise naturally in a rising pricing environment. And then lastly, I would say, I come back to the diversification point, which is in the current environment, if you have a portfolio or segment of your portfolio invested in contractual cash flows, those investments tend to be quite uncorrelated to what's going on in the rest of the market, and particularly in the rest of the credit world. So all in all, we find it a very compelling time to be investing in asset-based finance for some of these reasons.
So let's discuss how to implement this asset class within a private debt portfolio. It would interest a lot of viewers of this video.
Sure. Why don't we take an example? So typically, when we invest in a portfolio of assets, one of the more common investment strategies tends to be to invest in funding a specialty finance company. We recently made an investment in the UK where we invested in financing a portfolio of prime UK car loans or auto loans. There's three unique things which interested us to this particular investment, particularly in the current macro environment. The return potential was interesting, offering us and our LPs a mid-teens attractive return profile. Going to the risk that we were taking, it was a granular, diversified portfolio of car loans. So you have two layers of security. You have recourse to the end borrowers, who in this instance tend to be prime or high creditworthiness in nature, borrowers in the UK. The underlying assets, which give you the second degree of recourse, were a portfolio of cars, which secure these loans. And then the other aspect which we spend a lot of time on when analyzing a particular portfolio is who is the originator of these loans. In this instance, it was a bank which happened to be the second largest lender in the car finance space in the UK, which had 15 years of track record in the industry. So we were able to look at the return profile, the risk profile, which centered around the collateral backing, the prime borrower mix, and the subordination that we had from the originator, who had a 15 years long-standing track record. That is a classic example of an asset-based finance investment, especially in the current environment, where you're able to analyze a discrete portfolio of loans, the underlying assets that back those loans, the originator, their track record, and then run different stress cases. We were able to, in this instance, look at the risk return in a few different scenarios, including what would have happened if we replicated a GFC case or a global financial crisis type stress event. And even in those extreme scenarios, we found that the performance of this investment would still be quite resilient. So that hopefully gives you a good sense of a typical example of an asset-based finance investment.
Great. Maybe you are the first time here in Frankfurt at the AIC, I guess.
At this conference, yes.
Yes. So maybe you can introduce KKR briefly and give us a glimpse of your expertise, especially in the asset class, to make a round picture.
So the KKR credit business as a whole has 200 billion of assets under management. Within the credit business, the private credit business, which is where the asset-based finance strategy sits, represents about 75 billion of AUM. The asset-based finance strategy has been in operation since early 2016. We have built over the last 7 years a business with 40 dedicated investment professionals, 35 billion of AUM, and developed a strong track record across a global footprint spanning North America, Europe, and parts of developed Asia Pacific. These 40 dedicated investment professionals span 4 sectors that I touched on before: consumer finance and mortgages being our largest segment, commercial finance, which includes all form of investing to small businesses backed by essential assets, hard assets, which includes things like aircraft leasing, and contractual cash flows, which include things like music IP. So that, in a nutshell, is our asset-based finance business and where it sits within the KKR organization.
Many thanks.
Thank you.